Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Dave Erfle, founder and editor of the Junior Minor Junky. And Dave, I am sure happy that we pushed our call back from our normal Tuesday call time to Thursday because we wanted to see what came out of that Fed meeting, the press conference, and the market reaction. And boy, oh boy, did we have it really sounded like a change in narrative from the Fed and from Jerome Powell at the press conference, where the Fed showed us through their dot plot that they are planning on cutting rates next year, and even arguably about one more rate cut than people were expecting heading in, or at least what the dot plot was showing. And we have a term that I have really enjoyed over the last about 24 hours, a pivot party, where we saw all kinds of markets moving higher. We always stick to the precious metals markets. And boy, oh boy, we saw gold rally. What was it? Almost $100 in a matter of 24 hours. The stocks, especially the majors, took off. Silver went higher. There was a lot of green on the screen in the last hour of trading yesterday and even to start today on Thursday. Dave, what was your takeaway from that Fed meeting and this, what truly seemed like a pivot from the Fed?
Yeah, really super interesting. Corey, gold just is doing what gold loves to do best is whipsaw traders out of position as much as possible before a major up leg can begin. I mean, let's go back a little farther leading into this Fed meeting. I mean, after an extreme overbought gold price exploded to an intraday record high during thinly traded Asian markets to 2152. It began the month of December that way, and then since the move was just so sharp and it was extreme overbought already, these short-term traders had these windfall profits. I'm going to take these profits because the move happened on a geopolitical event in the Strait of Hormuz, which saw a U.S. ship get attacked, and a big, huge, nasty reversal candle resulted on the weekly chart. So that brought out the bears, right? Understandably, they're calling for a false breakout, which it certainly was, and the dollar started to go higher, and they expected the Fed to be hawkish, like most everybody did. So the gold price went all the way back down to below $2,000 on Wednesday before the Fed came out and shocked the world and basically saying that there's going to be not only a possibility of rate cuts, but a possibility of 3 rate cuts in 2024. And then the dot plot was revealed. And that's when the gold price really took off. I think gold went up $40 in the matter of an hour. And that dot plot revealed that 4 rate cuts in 2025 and 3 more in 2026, bringing the rate all the way down to 2% to 2.25% in 2026. So this announcement of the long-awaited Fed pivot, right? I mean, everybody was waiting for, okay, when is higher for longer going to shift to a definite pivot? Well, this is what the Fed basically said was we're not hiking anymore and we're going to start cutting. So that moved everything up. The Dow Jones Industrial hit an all-time high, which hasn't been confirmed by the Nasdaq or the S&P, by the way. And it was basically party on Wall Street. Everything went up as the dollar, which now has a head and shoulders top on its daily chart, a 4-month head and shoulders top, and the U.S. Dollar index broke 103, which is the neckline, and now it's all the way down to below 102. So we get a weekly close in the U.S. dollar index below 103. That could usher in a bear market in the dollar, and you know how bullish that'll be for the gold price. So now all eyes are on the last trading day of the year as far as the gold price is concerned, because although the gold futures made an intraday all-time high at 2090, a monthly close above this level is required for a technical breakout. So if we get a monthly, quarterly, and yearly close on the last day of trading, which is December 29th, above 2100, that would be a technical breakout, and it would likely trigger a strong advance into next year. And cup and handle breakout target, it's a 13-year cup and handle on the gold chart, would be a target of 2500. and has Fibonacci measurements being is at 2460 and 3300. So, we could see a really strong move in the gold price beginning next year if we get that monthly close above 2100 on December 29th.
So again, just watching those all-time highs and yeah, monthly closes, even consistent daily closes too, would all be welcome for I think at least some traders. But then again, it turns into a momentum play, doesn't it, Dave? As you're saying, like yes, monthly closes are fine, but if we truly want money or a bull market trend here, then momentum needs to continue to the upside. So it's not so much just a day in time. It is this momentum. It is consistent gains that we need to see.
Absolutely. And you saw this in the past on previous round numbers. We had a similar cup and handle in the gold price leading up to $500. This is when I got interested in the gold market back in 2003. That $500 level was the bullion bank's Maginot line of resistance back then, when we had a cup and handle of about 12 years below 500. And then when we had that monthly close above 500, that's when it took off, and it was more than doubled from below 500 by late 2007. So, and then the same thing happened at 1,000, where we had $1,000 bumping up again. We see when it first got to 1,000, it was extreme overbought. So it started to sell off below 1,000, and then of course we had the global financial crisis in the middle of that, and gold got all the way down to, I think it was $618. But then once the gold price had a monthly close above $1,000, it took off again, and then it nearly doubled. It actually more than doubled from that low of 618 a few years later in 2011, and it got up to 1925 and never reached 2000. 2000 was major resistance, and it's been major resistance for 13 years. So now the gold price, it had that monthly close above 2000 in November, and now it's trying to make a new floor at 2000, which previously was a 13-year resistance. So if the market starts to believe that gold is making a new floor at 2000, and once we get that technical close above 2100, I think that would be a sign that gold has made a new floor at $2,000. That's when the party's really going to get started in this sector. Because if you take a look at what happened with the equity markets, right? The equity markets are, I think it's safe to say that the sentiment is uber bullish in equities right now, and the Dow is at an all-time high, right? Well, gold is at an all-time high, and I think it's safe to say that the gold equities are uber bearish. So that's a real interesting dichotomy right now. So, and how tiny this sector is. It's not going to take much rotation from these, magnificent seven tech stocks, which basically have accounted for 70% of the S&P for performance that's up over 22% this year. So it wouldn't take much of that rotation coming into ridiculously undervalued gold stocks to really ignite the sector. I mean, you saw how quickly white candles popped up yesterday in these majors in Agnico Eagle and Newmont. Within the space of an hour, they were up 5-6%.
Yeah, those majors, man, oh man, they move so much. There's even, I think Newmont was damn near up 10% within about a 24-hour period. Has given a little bit of that back, but there are some major moves that have happened. But Dave, to your point, the rest of these stocks, they have lagged. And quite frankly, you look at the market environment and find the Magnificent Seven, they have done well. We did see a little bit of rotation into some other sectors, and the move into gold and other commodities. Do you think the problem is that some of the gold stocks are still just very much risk on assets, to the point that unless we see a broadening of where investors are looking, they're almost still in a way playing defense, sticking to a select number of stocks and buying some of the bigger stocks? So they're just not willing to go down into the smaller stocks, even if they're gold stocks or any other sector of stocks?
Well, yeah, because and also you gotta look at the fact that the gold price had been bumping up and false breaking out above 2000 so many times that investors just gave up on it, I'm like, okay, costs are going up and gold can't get above 2000. Why am I going to mess around with gold stocks when I can put the money in the stock market and make money? That's where a $2,000 floor will come in and really make a difference. I mean, what's happening right now with these Magnificent Seven stocks kind of reminds me of the dot-com bubble in early 2001. I think, the market was expecting a rate cut from Alan Greenspan at the time. And, the party was really coming towards an end in the tech stocks. I mean, the valuations were ridiculous. The PE ratios were ridiculous, and they kept getting more ridiculous. Everybody was saying, okay, Greenspan's going to cut rates and we can make even more money. Well, it's just like what's happening right now. The investors are focusing on the actual rate cut, not on the reasons why we're having rate cuts. So that's what happened in 2001. Also, Greenspan finally cut rates. And I think within a week, that's when the party was over in the tech stocks. So we could have a similar situation happen once the Fed finally cuts rates. This time, the most important thing for the gold price is the market needs to be convinced. I mean, the most important thing for the gold stocks is the market needs to be convinced that we have a solid gold floor at $2,000 an ounce.
Well, we will see if we get to that point, right? But let's talk about some of these other markets, because you did mention the US dollar, how much lower that has moved. And we've seen some major sell-offs in the dollar just in the last couple months. I know that yesterday the dollar moved down a full 100 basis points, and then today it's down almost another 100 basis points. But it was back in mid-November, November 14th, that it was down 155 basis points, and November 3rd that it was down 110 basis points. So there's been some big moves down in the dollar, and also rates. The 10-year, it was the tail end of October that it was up near 5%. Now it's under 4%. Have either of these markets gone maybe a little bit too far on the downside to your idea?
Well, if you take a look at the dollar, I mean, like I said, it's got that head and shoulders top on the daily, and if you look at the RSI on the weekly, it's only at 40, and it just broke that neckline at 103. So there's plenty of room on the downside yet, and we had both the ECB and the Bank of England come out and keep rates steady, and they're not even discussing lowering rates. While you had a Federal Reserve come out and not only discuss but lay out a timeline of when they're going to cut rates. I mean, that's the impetus for why we see a dollar move so much lower right now. As far as the Fed is concerned, this is what everybody's been waiting for. I mean, real interest rates need to come down, and that's going to happen now. So that's nothing but bullish for the gold price, and especially for gold stocks that need that $2,000 floor.
So what are you looking at within the gold stock sector? Because as much as we talk broadly about how well the stocks have done, at least in the last couple of days, it's still a lot of the majors that have rebounded, but they're still a long way off of highs. A lot of these juniors are still pretty washed out. A lot of them still need to raise money. So is it simply share price action? Is it news flow that you're looking for? What is going to signify to you that, look, we do have this environment where almost everything is going higher?
Yeah, we need to see more mergers of equals. We saw another one this week in Finland, and we're going to need to see more majors take strategic investments. But I would not like to see more than 9.9% of a strategic investment in a junior that I would own. As far as the capital markets are concerned, that window needs to open. But also, I mean, on the flip side of that, there's just too many juniors right now chasing a limited amount of capital who also expect that a major miner is going to eventually come and buy them out. There's just too many juniors attempting to de-risk marginal gold and silver projects, while most of them are trying to convince a market devoid of retail generalist investors right now that a mid-tier or a major is going to buy them out. So as far as, a lot of these analysts, professionals coming out and saying, once the gold stop, once the algorithm switch flips, and it goes from uber bearish to newly bullish, the rising tide is going to lift all boats. I don't think that's going to happen this time, because, the last several times that it has happened, the capital market window opened up and most everything got financed. Well, capital's not cheap anymore. these banks are more intelligent as far as the resource sector is concerned. They understand what I just said, that there's just too many juniors chasing a limited amount of money that are de-risking marginal projects. So and global miners understand this too. So they're just patiently waiting around until juniors that are de-risking these multi-million ounce gold projects with blue sky potential, the good ones, right? They're so desperate that they have zero bargaining power, and then they expect them to take them out of bargain basement prices. So that's where smart speculator comes in and says, it's really important to concentrate on these quality juniors that are de-risking these large projects in safe jurisdictions, by the way, controlled by serially successful management teams, and they have the access to capital. And also they have plenty of skin in the game to dissuade take under bids. Because, Corey, we've talked about some of the take under bids we've seen recently, where the mid-tier that's taking over the company at a bargain basement price, they get the great part of the deal. And then the junior that sold out too cheap, where only the people who got lucky and bottom fished the stock and got some of the premium, they get the fuzzy end of that lollipop. And those are the kind of takeouts we don't want to see. That's going to happen with companies that have maybe previous management team did all this work. They spent hundreds of $millions of de-risking this project, and then a new management comes in that doesn't have very much skin in the game, and they're trying to take it to production, or they're trying to take it to a timeline to production, and they're not going to make a lot of effort to dissuade a take under bid. So that's why it's really important that you have to make sure that you're accumulating the right stocks here, because there's so many of these stocks that aren't going to move very much when this sector flips, because either they need money or they're de-risking marginal projects.
Yeah, there's so many marginal projects out there and so many companies looking for cash too. But I know some people, they first of all, sometimes get stuck into some of these, and other times, well, they see just how beat up they are and think, wow, look at how much more money I could make in them. But again, it's all kind of that risk management, but at the same time, sticking to the better companies can also limit your downside. Not saying that there can't be downside, but this week on Wednesday, boy, oh boy, a very different type of market and a very different message from the Fed that sure lit a fire under a number of different markets. But since we focus on precious metals, it really moved up the precious metals prices, and especially some of the majors, which are holding on, at least for now, to a lot of those gains. I know a lot of people listening just waiting for that to filter down to the juniors, which we have seen some life, but there's a lot of upside to go for some of these guys. Dave, thank you as always for your time. We'll try to chat next week. We'll see if there's anything major to talk about, but it's been a pleasure chatting with you this whole year anyway, so we'll fit something in before the end of the year. Hope you have a great rest of your week there, Dave.
You too, Corey. Thanks again for having me on every week. It's always a pleasure to speak to your very, very informative audience. They always have a lot of great comments to say on these interviews.